Hi, here at Credit Repair Shield, we don't want to just fix and repair your credit. We want to educate you and inform you on why your credit is so important and how you can protect yourself and your capital now and in the future. Extremely important, and we're going to go over how all that works here in this presentation. So, what is a credit score? The first thing, and how does it work? What does it mean? Well, let's go through that. Your credit score, what does it mean? Well, by definition, your credit score predicts the statistical chance of a consumer becoming 90 days or late or more on a particular loan obligation. Each score is specific to each bureau, and you'll see each one of your scores is different. You'll go, why? How can I have a 50-point spread or more between the bureaus? Your score can range from 300 all the way to 850, and we'll go through that. The higher the score, the less the odds of default. And the score is generated by what's going on today, not 2 months ago, not even 30 days ago. Your score can change month to month or even more often than that, depending on what's going on in your life. So, consumer default, what are the odds? Well, here we go. This is going to show a little chart of some of the scores. You're probably not on this chart. If you're above 800, your score's above 800, then there's a 1,200 to 1 shot that you're not going to be 90 days late or more. Let's come down to where we're the top of probably where you may be, 680 to 699, 55 to 1. Look at the change just from above 800 down to 680 to 699, 55 to 1, down from over 1,000 to 1. Now, when we get into the area where most people need to get a house or a car or even a credit card, 620 to 659, you're 26 to 1 odds. This is kind of like Vegas placed odds on you. You know, people go to Vegas and set bets all the time on sports games or whatever. Well, the credit bureaus set the odds on you. How likely are you to be 90 days late on any given payment? Now, 500 to 600, 8 to 1, and if you're below 500, forget about it. So chances are, if you're looking at this, we need to get you at least to 620 to 659, so you get into that range where you're not a really bad bet, or the odds aren't completely against you, right? So look at this chart. If you're at the 720 to 850 range on a 30-year fixed rate for a home that costs $250,000 or a loan of $250,000 at a rate of 5.3%, for example, your monthly payment would be just under $1,400. The same loan, if you have a score of 500 to 599, that monthly payment is $2,175.48. Look at the difference just from a credit score. Now, take that a step further, and you'll see that if you've got two people, one's named Jack, one's named Brad, they've got the same salary. Look at the credit score. Jack's at a 681, Brad's at a 595. The yearly savings for Jack would be over $14,000 even if they had the same salary, based on their credit scores. That's a yearly savings of over $7,000, and interest saved over 30 years is over $214,000. Is this starting to make sense? You're starting to see why your credit score is incredibly valuable and important to you, not just a couple of bucks here and there. So what are the determining factors? What makes up your credit score? Here are the 5 items. We're going to go through these one by one. The first thing are your past delinquencies. This is 35% of your score. Now, what determines that is the timing of the delinquency. When did it happen? The date. The level of the delinquency. How much was the amount? When was the last activity date? When was the last time you had any kind of payment or anything notated on that account? That's the last activity date. Past due notices are not good for your score, and any missed payments accrue a little bit differently based on how much they are. Something that's a $2,000 payment is going to be weighed heavier than something that's a $100 payment. Payoff collections in escrow not before. This is a kind of a educational thing here. If you have collections that you're looking to settle, you don't want to pay anything off or settle anything until you're in escrow for the loan you're looking to close on, or your score could change for the worse. So keep that in mind. Now, the next thing we're going to look at, how long do delinquencies stay? Well, by law, they can stay on as long as 10 years if it's a Chapter 7 or 11 bankruptcy, up to 7 years for a tax lien, up to 2 years for an inquiry, and you'll see everything on this chart. However, there is no law that requires anything to stay on your account for any length of time. And we have the right, you have the right, to have any negative item or anything that you're not absolutely positive that it's accurate to be verified by the credit bureaus. It has to be verified in a timely basis, and that's got to be done accurately. So if something is not proven accurate in a timely manner, then they must delete it. Even if it's a bankruptcy, a judgment, tax lien, anything can come off your report. Now, there are strategic methods and tactics to do that. You just don't write a letter, common template letter. That won't work. So anyway, the next item that comes into play with your credit report, revolving debt ratio. That's 30% of your score. Here's what that means. Your cards. You should share debt among many cards, not just one. Okay, this 30% of your score, and what's going to work in your favor is if you use every single card you have at least once every 6 months, or it could go inactive, it won't report, etc. You also want to have a balance of at least $1 every time you have a payment cycle. That proves that you have the ability to pay your debts. If you have a zero balance, you're not proving anything, and that's not going to report positively to the credit bureaus. You don't ever want to close a credit card, as you'll see in another one of the components that makes this up, because if you keep those lines of credit open, that counts in your favor also. You also want to pay off before the closing date and get added as an authorized user if you can. Now, credit limits. Ask for credit limit increases if you can. Maintain balances on your cards below 10% and make sure the limit is reported. If you have a credit limit increase, make sure that's reported to the bureaus. That will work in your favor as well, and we'll show you in just a second why. The revolving debt ratio. Spouse. Keep credit cards separate from your spouse and transfer all debt to one person. Utilize business lines of credit. That's completely different from personal lines of credit, doesn't attach at all, and can give you a lot of leeway in your businesses that you're working on, aside from anything personally, and you should separate the two anyway. Now, number 3, the average age of the credit file. This is 15% of your score. The longer the history, the better. That's why you never want to cancel a credit card or close one, as you see right there. Piggyback off mom to get a history if you can, although that's not your best strategy. That'll work to your advantage. Now, the mix of cards. This is 10% of your score. What do we mean by that? This means having a mix of credit, not mix of cards. Mix of credit means you want to have a car loan, 3 to 5 revolving credit cards, a mortgage account, a car loan, etc. Having a variety, even an equity line, although in today's day and age, obviously not very likely to get an equity line of credit, are we? But the mixture is going to help you. That's 10% of your score. And the 5th way are inquiries. An inquiry is anytime someone inquires about your credit worthiness, whether you're applying for a loan of any kind, which those will count negatively against you, and anytime you request or pull your own credit, that will not work against you. So as you'll see, inquiries can cost you 0 to 50 points. You pull your own credit, 0. Doesn't affect your credit at all, but it'll affect it positively. One of the reasons why you want to use Credit Keeper, as we recommend it, is every 30 days, not only can you log in and pull your report, but it'll bump off the negative inquiries if you have 10 or more. Scores, as you see, the score is only reduced on the first 10. So when you have the ones that don't affect you negatively keep coming up, whether you're pulling your own credit or as you'll see any of these other factors, I'll talk about in a second, that'll bump up the negative items. Now, if you're looking for a car or a home, you have the ability to look for a loan for 30 days, and you'll only get one inquiry as a result. That way, if you're house hunting or car hunting, if you go look at a bunch of them, you're not going to get a whole bunch of inquiries on your report as long as you do it within that time frame. So keep that in mind. And these are the inquiries that don't count. Personal inquiries, like pulling your credit report with Credit Keeper, promotional or job-related inquiries, and insurance and account reviews. So to review, we have past delinquencies, 35% of your score. Debt ratio, 30% of your score. Average age of the file, 15% of your score. Mix of credit, 10%. Inquiries, another 10%. That's 100%. That accounts for your score. Now, we're going to go through your individual credit report. We're going to look at the negative items. We're going to make sure that the items that seem accurate are verified. We're going to ask you a lot of specifics, and you'll start to understand how your score came together and how we're going to strategize to improve on that based on our years and years of experience on all the federal laws that protect you as a consumer from the illegal activities that the credit bureaus engage in to help restore and repair your credit to the optimal level that you're looking for. Thanks. Have a great day.